May 28th was about more than just navigating a noisy market. The signal was much sharper. Bank of America noted that trading revenue is tracking roughly 15% higher than a year ago. That turns market volatility from a simple complaint into a real revenue line. For investors, it leaves a harder question. If Wall Street is getting paid by the chop, who exactly is carrying the risk?
This is based on recent management guidance. Brian Moynihan stated that Bank of America's second quarter trading revenue is expected to jump about 15% compared to last year. While he noted the comparison is helped by last year's tariff shocks, the core message holds. Client activity, hedging, and repositioning are all showing up as direct revenue for the banks. Think of volatility like traffic. When the roads are empty, trading desks have fewer opportunities to help clients manage their risk. But when the volume is heavy, clients are forced to hedge, rebalance, and shift their exposures. That activity drives volume and widens spreads. The market does not need to be heading up for banks to profit. It just needs to keep moving.
Oil provides a clear example of this backdrop. Brent was trading around $94 a barrel, staying below the $100 mark for several sessions, as investors looked for signs of a U.S.-Iran peace path. That is still expensive oil, and it keeps inflation anxiety in the room, but it lacks the immediate panic of a fresh price spike. This lower fear gives stocks some room to breathe, while keeping volatility alive.
Recent consumer data kept the debate moving. The BEA reported that personal consumption expenditures rose 0.5% in April, but disposable income actually slipped by 0.1%. Once you adjust for inflation, real spending only grew by 0.1%. The consumer is still here, but the financial cushion is thinning out. That explains why the market can hold its level and still feel uneasy.
The inflation picture remains complicated. April PCE prices were up 0.4% for the month and 3.8% year-over-year. Core PCE rose 0.2% monthly and 3.3% from a year ago. We are not back at a 2% inflation story yet. This suggests the Fed will remain cautious, and growth stocks will have to continue justifying their valuations under a persistent rate ceiling.
There was some encouragement for the bulls. Goldman Sachs raised its year-end target for the S&P 500 to 8,000, pointing to stronger earnings power. An 8,000 target isn't a guarantee, but it highlights why many buyers are willing to look past the noise in oil, inflation, and policy. If earnings keep doing the heavy lifting, investors seem willing to tolerate a messy background.
Dell provided some additional fuel after the market closed. The company reported record first quarter revenue of $43.8 billion, an 88% increase, including $16.1 billion from AI-optimized servers. That is a large growth signal, and it shows the engine behind risk appetite is still running hot, even as we focus on the broader market volatility.
That fuel is not reaching the entire market. Goldman noted that companies tied to AI infrastructure could account for about half of the S&P 500's earnings growth this year. That is a great environment if you own the winners, but it creates tension if the index relies on such a narrow group. Concentrated earnings can drive a market higher, but it also means the reaction is much sharper when expectations are not met.
We are seeing the downside of this shift in the credit markets. Software loans are facing more scrutiny because AI could potentially disrupt the recurring revenue models that lenders once considered extremely safe. S&P Global has flagged this software exposure as a growing concern for private equity and credit portfolios. While trading desks might profit from the chop early on, credit markets eventually find where the risk is hiding. On the policy front, crypto remains on the watch list. Representative Nick Begich introduced the ARMA bill, which proposes a strategic Bitcoin reserve and a separate digital asset stockpile. The proposal focuses on treasury custody, transparency, and a 20-year holding period for reserve Bitcoin. It matters for digital assets, but it is still a watchlist item for this equity market episode. Looking ahead, there are a few key areas to watch. First, whether bank trading desks continue to see revenue gains from volatility. Second, whether oil prices stay below that $100 panic level. Third, whether consumer spending can hold up without triggering a more aggressive Fed. Fourth, if earnings from companies like Dell continue to support risk appetite. And finally, whether the stress in software credit begins to spread. The core takeaway is that market chaos impacts everyone differently.
For the banks, it turns into trading revenue. For index bulls, strong earnings provide a way to look through the noise. Consumers are still spending, though their cushions are shrinking, and credit markets are identifying where risk was mispriced. May 28th was the day the chop itself became the primary story.